Okay, we'll be going through some financial ratios now. Okay, so financial ratios are used more as a means for fundamental analysis of stocks. Okay, fundamental analysis of stocks, alright, and as opposed to just discounting cash flows like the DDM. Alright, so this is the more often used method of analyzing stocks to invest on. The first financial ratio that we'll be showing is the EPS, right, or the earnings per share. Okay, earnings per share. Okay, essentially is calculated as the total earnings, okay, divided by the number of shares, alright, or the net income of the company minus any dividends on preferred shares divided by the number of outstanding shares. Okay, so earnings per share, okay, it's some very important variable in determining a share price. Okay, so assume, for example, a company has a net income of 25 million and it has given out 1 million preferred share dividends. Okay, so we subtract 1 million and then it has 10 million shares, right? If it has 10 million shares outstanding, right? So this would be 10 million, hence over here the earnings per share would be 2.4. So with a figure of 2.4, it will tell you that for every share of the company that you hold, it will make $2.4 has been earned on it. Okay, we'll talk about another ratio called the PE ratio. Okay, and the PE ratio is calculated as the market value of the company, right, or we call it market cap, divided by the earnings per share, which we have earlier mentioned. Okay, so this is a valuation ratio of a company's share price compared to its earnings per share. Okay, so say a current stock price of a company is $43, okay, and earnings per share is $1.95. Okay, the PE ratio would simply be 143 divided by 1.95 to be 22.05. Okay, the PE ratio is also known as the price multiple. Okay, the price multiple or the earnings multiple. Okay, so the PE ratio actually shows us how much an investor is willing to pay per dollar of earnings. Alright, what is the amount that you are willing to pay for $1 of earnings? Okay, so for example, PE ratio of 20 would mean that you are willing to pay $20 for $1 of earning. Okay, now the P, what does the PE ratio reflect? Okay, importantly, it reflects how the market views the company's growth potential. What is the growth potential of the company as viewed by the market? The growth potential. Okay, so for example, a company, if it has a high growth potential, we would think that the PE ratio would be high. Okay, and vice versa. If the PE is high, you would know that the market expects high growth potential. Okay, now given this, right, hence would it just be wise to invest in companies with high PEs? Now the thing is, high growth potential, okay, it has yet to be realized. So in the event in the future that this does not happen, okay, there will be a huge drop in the stock price. Okay, so back in 2000 and actually before that, Microsoft was doing very well with its world domination of operating systems using Windows, its P ratio then, okay, was more than 100. Okay, but obviously it cannot maintain the kind of growth that he has done before, and it has soon dropped. Okay, in 2002 it has dropped to 43. Okay, so it's common among large cap companies, right? Large market cap companies, or what we call blue chip. Okay, it's common among them that initially when they started, they will have a supernormal phase where the P is very high, and then it will slowly drop to a lower PE, okay, to signify that the growth potential is no longer so high. So a P ratio is very useful in that it's just it signifies the growth potential of a company, okay, better than just P alone. Okay, now how do we determine that if a company stock is cheap or expensive? Okay, we can use P to help us. We cannot just base it on P. Okay, why? Now, for all things, suppose we have a $10 stock. Okay, but the PE is actually 75, and we have another stock which is $100, but the PE is just 20. Okay, which means actually that in this case the earnings per share of the stock is, okay, the earnings per share in this case would be 100 over 20, which will give us 4. But in this case, the earnings per share is, okay, 10 divided by 75, okay, which is just $0.133. Alright, so although the stock price is 100 over here, okay, but looking at the PE, given that it's only 20, we can calculate that earnings per share is $4, which is much higher than compared to this. Alright, so in this case, we say that now this particular stock, though the stock price is more expensive, is actually a cheaper stock. Okay, because of the high PE. Okay, there's a high earnings per share. Okay. Right, so we can compare companies using the PE ratios, and it would be better suited if we compare them, okay, the companies in the same industry. Alright, because certain industries, they have very phenomenal growth rates. For example, growth industries, okay, things like technology, they would typically have a higher PE. But for industries like more defensive ones, like the healthcare, they will have a lower PE average. Alright, so it makes sense that we should compare P ratios of companies in the same industry. Okay, you can find out about a company's P ratio very easily and very readily available. Okay, so back to my technology stocks. Alright, you can look at the P ratio of the stocks in the technology industry. Okay, so if I sort the P ratios, oh, look at LinkedIn. Okay, it has an astronomical P ratio of 1:67. Now, this is very highly suspicious. I think be very careful before you invest in this company. Also look at Amazon. Okay, it's expecting a huge growth potential, perhaps because of the Kindle Fire. Now, what about AOL and Microsoft? And now this looks more modest. All right, so you see the current PE ratio from a high of like 100 over to a current 9.44 for Microsoft. Okay. Alright, again, we can use the stock screener to help us. Alright, certain tips on using P ratios, certain tips on stock picking is that we can look at companies with P ratios in the lowest 10% of equity securities. So let's say in the lowest 10%, okay, that would mean if we were to put it like this, somewhere like this, I would say P ratios of or perhaps we will just use a particular sector since this is more meaningful. This is technology again, right? So from 0 to 1.84, and oh, no companies found, so let's increase this. Okay, so we get the following companies, all right, where you have a lesser P ratio, and as you increase this, you get higher PE ratio. So these are the companies which have a lesser P ratio in the technology sector. Now let's try healthcare, for example. Okay, you notice that for healthcare, the P ratio average is slightly lower than the technology one if we were to compare. Oh, actually, the P ratio of technology is actually lower in this case for now. Okay, but of course this does not mean that we should just simply invest in low PE stocks, but rather companies which are undervalued would reflect a low PE. Alright, the next ratio that we'll be talking about is the PB ratio. Okay, the PB ratio, where we compare the stock price against the book value per share, or in other words, alright, we actually take the market cap of a company and divided it by the book value, which is actually total assets, okay, and subtract away any intangible assets, okay, things like trademark, brand name kind of thing, and also to subtract away liabilities. Okay, so in short, okay, this one actually equates to our equity. Okay, equity. So PB ratio is calculated as this. Alright. So in this case, again, we would think that as the PB ratio is lower, chances are that the stock would be more under value. Okay, so okay, the market deems this ratio as important as well, because for P, it would be the market demand for the particular company. For B, it would be, alright, financially wise, what is the equity of the company? Okay, remember that we know that we have assets equals to liabilities and equity. Alright, so this portion of we have to pay off to creditors, and it's only this sum of money which is owned by the company. So the market value shouldn't be too far away off from this portion. Okay, shouldn't be too far away off. So we expect that PB ratios, okay, they would have they wouldn't fluctuate as much as PE ratios, and it should be that we should look for PB stocks with PB ratios less than or equal to 1. Okay, again, we have to make this comparison by industry. Okay, certain advantages, okay, of the PE ratio. Okay, it's easy to use, and it's very commonly used method of valuation. And there's research that have proved that it has a relationship of what we call correlation, okay, to long-term returns. Alright, and advantages of using a PB ratio, okay, it's stable, alright, because B, or the book value, okay, it does not fluctuate as much between quarter to quarter, right, and it can be used even when the firm, okay, has a loss. Okay, in the case where a firm has a loss, you cannot use PE ratio anymore because there will be negative earnings. I'm sorry. Okay, but we still can continue to use the PB ratio. Okay, hence it's a good ratio to use for firms in distress. So disadvantages, as mentioned, the PE ratio, when companies that have make losses, you can't use this. Alright, and now earnings, okay, the E, earnings, can be very volatile. Okay, can be very volatile as because they can be manipulated by using accounting standards, by different accounting standards and rules, and also by management. Okay, we'll learn more of this in your accounting subject. And so for the PB ratio, some disadvantages, okay, does not take into account the relative asset size when comparing firms. Okay, you do not compare against firms that have roughly approximately the same book value, okay, or size. Alright, and again, accounting can actually give us a false picture of the book value. Right, and lastly, book value, okay, is not accurate measure of market value. Okay, so an example on using our PE and PB ratios to analyze two companies. Suppose we have two companies, new coal and old coal. Okay, the current price is this, earnings per share is this, sales per share, book value per share, cash flow per share. Alright, we'll be concentrating only on the PE ratio and the PB ratio. So given the above results, okay, based on the PE ratio, right, we think that new coal appears to be undervalued as opposed to old coal, because 25 for new coal and we have 27 for old coal. Okay, so based on the PB ratio, right, old coal seems to be undervalued relative to new coal. Okay, so that we can see that analysis of under or over valuation differs by using different ratios. So we shouldn't be using only just a P ratio or just any one ratio to analyze companies. We should use a multi-array of ratios and tools.